Ask yourself a question. If you deleted every indicator from your chart right now, RSI, MACD, moving averages, and left only plain candles, could you still trade? Most traders would say no. They rely on crossing lines to tell them when to buy or sell. But those formulas are calculating past data. The price moves first, and the indicator reacts later. Look at this chart. As we strip away the glowing indicator lines, we're left with the raw data of the market. This is price action. We are going to examine the shape and structure of these plain candles to determine whether buyers or sellers are dominating the current session. By reading the direct source data as it unfolds, you see the market's momentum before it is filtered through a formulous delay. Step 1 is understanding the micro level. Every individual candlestick on a chart is a self-contained record of a battle between buyers and sellers. This diagram breaks down that battle. Specific things: the open price, the close price, the body where the bulk of the action happened, and the shadows, or wicks, showing the price extremes. When you see a large body with very short shadows, it indicates that one side, either buyers or sellers, exerted strong, uninterrupted pressure. Conversely, a small body caught between long upper and lower shadows reveals a tug of war. The market pushed in both directions, but neither side could hold ground. By evaluating these proportions, you can determine who controlled that specific time period. Now that we can read a single candle, we need to zoom out. Price rarely moves in a straight line. It moves in waves. This chart highlights the natural rhythm of the market. The peaks, where price tops out, are called swing highs, and the valleys, where it bottom are swing lows. When the price pushes past a previous swing high, buyers are showing dominance. If it drops below a previous swing low, the sellers have taken over. These turning points establish your support and resistance zones. They mark the specific areas where the actual battles for market control are taking place. These zones hold weight because they are areas where massive clusters of traders have historically placed their orders. Plotting out these swings and zones gives you a logical roadmap. It highlights the areas where the market is most likely to show its next reaction. You have your map. Now you need a strategy. We're going to wait for specific candle shapes, and we only act if they appear directly at our support and resistance zones. First, the pin bar. This shape features a tiny body and a long shadow. Here, it is forming against a support zone, with its long wick pushing back up. This indicates a rejection of lower prices. Next is the inside bar. Notice how this entire candle is completely contained within the high and low of the previous candle. This signals market compression, a tightening of price before a potential breakout. Finally, the engulfing candle. This occurs when a large body rapidly forms and completely swallows the smaller preceding candle. It signals that one side has stepped in and dominated the other. Remember, these shapes are almost meaningless if they form in the middle of a chart. Their value comes from appearing at established structural zones. When you combine these three specific candlestick patterns with support and resistance, you have the foundational signals needed to identify a high probability entry. A common misconception is that trading price action means you must banish all indicators from your screen. That isn't necessary. This layout shows how the two methods work together. On top, a pin bar rejects support. On the bottom, an RSI indicator dips into the oversold territory. The indicator is used to confirm the price action signal. However, technical charting has limits. You should generally step aside during fundamental macroeconomic shocks. When major news drops, like this RBI policy press conference, normal market structure often breaks down. Volatility surges, and candles can form and fail in seconds. Price action is a precision tool for standard market environments. It is not designed to predict the outcome of unpredictable economic chaos. You now have the basics: reading raw candles, mapping market structure, and identifying entry signals. Your task for today is simple. Open a 10-minute chart and remove all indicators. Do not take any trades. Just sit and observe how the price behaves as it approaches and reacts to key levels. Before you do, drop a comment below. Are you already trading without indicators, or is this your first time looking at a naked chart? In our next session, we will shift to mathematics. We will look at the work of Leonardo Fibonacci and explore how specific ratios can help identify potential targets for your trades. Until then, focus on observation. Mastering these core visual skills requires discipline before you move on to more complex tools.